Welcome to this week's live ASX strategy session. Thanks for joining me. Great having you with me for another show. Lots of interesting things to go through today. New all-time highs in the ASX 200. What's going on over in the S&P? Lots of things to talk about there. And also the commodities and any stock codes you'd like me to have a look at. Get those codes ready. We'll go through those in the second half of the show. As always, everything today, general commentary only, doesn't take your personal situation into account. Having been through all of that, let's get into this week's first chart. And starting off with the ASX 200. And well, new all-time highs for the ASX 200. But can it continue without support from the mid-caps? I'll talk more about this in a moment. And then over in the US, it's a period for the record books, although there's a bit more to it than meets the eye. I'll show you what I mean by that in a minute. But before we get to that, let's start with this latest price action in the ASX 200. And as I said, it's a new all-time high for the local index, and that surpasses the previous mark from about a week ago, and it's now a clear break above the all-time high from last October. It's interesting to notice the structural change over the last few months. So, first of all, we had the break below the moving averages in November, and that signaled the likelihood of a period of consolidation, and that followed that strong trending period from the April low. And well, the ASX 200, it did spend several weeks consolidating below the moving averages, but most importantly, it never actually broke down from that consolidation. And by that, there wasn't follow-through selling. And this is an important lesson. This is an important lesson of market structure where you get the initial sell-off, you get the rally, and you don't get the follow-through selling. It's that, and the important part is, it's not so much the initial dip below the moving averages that ends the bull market. It's what happens next. Is the rally sold or is the dip bought? If the rally is sold, so say we get the rebound, if the rally is sold, that's when you get the series of lower lows, and that's bearish. But of course, that never happened in this situation. From just recently. Instead, prices rallied back above the moving averages, and as we've been discussing in recent weeks, they then re-established themselves above the moving averages, and now we have the return of momentum. I remember discussing how back in November, it was mid-November, I remember discussing how it seemed to be a general feeling of panic just after that sharp down day below the moving averages. And while it wasn't a great day in the market, there hadn't been that bearish shift in the structure at the time. It was an unpleasant day, might have been an unpleasant week, but nonetheless, we didn't have that structural change that signifies a bear market. And I think this is where a rules-based process is so important. So rather than getting swept up in the emotion of a big down day or a big down week and then selling indiscriminately, stocks in your portfolio just saying, I want to get out and selling things, it's a case of having that clear-cut rules-based approach that tells you what to do. So we don't need to react emotionally, we'll react based on our trading rules. I sold some stocks during this period that hit their exit levels, but I also held on to a lot more. And many of those stocks which I've continued to hold because they stayed above their wide trailing stops, many of those stocks are now at, like the ASX 200, at new highs. I've also bought some new stocks as buy signals have appeared during this period. So with the ASX 200 at new all-time highs, I think it's just a good time to reflect on the last few months because these periods are pretty awful when we go through them. But when we look back and we look at how we've handled them and what we're now doing, I think there's a real benefit in doing that. And remember, don't let scary down days, or scary down weeks spook you. Instead, consider it in the context of the overall market structure, which we discussed. It never turned bearish because we never got the follow through selling. So consider it in that overall market context. And most importantly, stick to that predetermined plan. Get a good plan and stick to it. That's how things all work out in the over time. Okay, so what do we make of this latest price action of the new all-time high? Well, I thought we might have seen a bit more consolidation before the all-time high. I thought there could have been a bit more chop back and forth along the moving averages. But there's been a strong return of momentum, and that's largely due to resource stocks. I'll get to the resource stocks in a moment. You can also see the dips have been being bought. So what we've had like just looking since mid February, strong rallies, shallow pullbacks, strong rally, shallow pullback, again strong rally. So I thought this second consolidation, I thought that may have just seen things drift sideways for a week or two, but that wasn't to be. The moving averages also continue to move higher. So we can say it's a clear case of a trending market. So coming across to those materials, the materials index, this is where all the big mining stocks, are included. This has been the big driver of the ASX 200 in just the last little bit. In particular, BHP. We've discussed this trend a lot pretty much over the last 8 months, and it remains. As I say, it remains a key driver of the ASX 200. I want to stay with this trend in resources, and there's been plenty of motion trader signals in this space as well. So lots of resource companies have been doing well. I think the key is to use those wide trailing stops to try and see off volatility along the way, because there definitely is volatility. As we know, in all shares, and mining shares are notorious for volatility. So those wide stops that are below a 100-day moving average, there's a 50, there's a 100-day, a wide trailing stop would often be back below a 200-day moving average. That's how I'd stay on these big trends or at least try to stay on these big trends in mining stocks and see off volatility. I said last week that I thought materials were getting a bit stretched, and maybe they might have come back and retested the moving averages, a bit more sideways work before heading up. But of course, they just moved higher. There was no consolidation beforehand. Like I said, I want to stay in the trend. I am a bit hesitant to be doing much buying at current levels. Prices can always get more stretched, but at some point, the moving averages do catch up, prices do come back to the averages. So just making sure risk reward is all stacks up before buying a stock which has been running hard. Coming over to the financials, and this is of course the other big sector in the ASX 200. We discussed the likelihood of some consolidation last week, because we'd had that big move from below the moving averages to above. Often when you get that flip from below to above, you then get a pause while the moving averages catch up, and that's been playing out this week. So this is one area where the consolidation theme has come into play. We could see financials continue to chop over the next few weeks, just as these moving averages catch up a bit. But overall, I think the structure for the sector is positive, and I think it provides another strong underpinning for the ASX 200. One last component to look at, it's the equal weight, the ASX 200 equal weight. I like that it's stabilised, and there hasn't been any follow through selling whilst it's been below these moving averages. That's constructive, but it is still generally below the moving averages. So the strength we're seeing in the ASX 200 is largely due to a rally in big caps. Many of the mid and smaller tier stocks within the ASX 200, they can still continue to consolidate. And that's what we're seeing play out in the ASX 200 equal weight. The equal weight's essentially been range bound since October, just been back and forth within a large range. And when you consider the strong gains off the April low, so a big rally and then a sideways consolidation, it's fairly typical sort of stuff. We often see this we often see ranges develop after big trends. While this latest stability in the equal weight is good, I want to see the equal weight clearly back above the moving averages. It's testing the moving average region at the moment, but I want to see a clear flip back above the moving averages to really start to build that strong base below by getting back above, and then we want to see prices establish themselves above the moving averages, and that would start to bring the equal weight more back in line with the ASX 200. Just quickly coming back to the ASX 200, as we discussed last week, I think the play is staying long stocks and it's letting winning positions run, wide trailing stops. The ASX 200, this remains a bullish structure, and I think we'll see higher levels in the months ahead. Of course, it's not going to be a straight line. There will be the consolidations and the pullbacks, but the structure's positive. It's the structure of a bullish trend. Okay, we're going to go to the US market now. Go to the US market next. Then we've got the small caps, the commodities, all of that coming up. But first of all, if you're getting some value, please click that like button. Helps me heaps when you do that because it sends a good signal to YouTube, and YouTube shows other people. And that makes the whole thing work for me. So please click that like button. And what do you think? Do you think materials, do you think BHP is due for a pause, or do you think BHP is going to keep running? Tell me what you think's going on in the comment section below. All right, over to the S&P 500. So another week of tight consolidation for the S&P 500. In fact, this is now one of the longest stretches of compressed price action on record. So I saw some research through the week that the S&P 500, it's closed within 2.5% of its 50-day moving average for the last 63 trading sessions in a row. So this red line, that's our 50-day moving average. So 2.5% either way, and it's been there for the last 63 days in a row. So that's an unusual streak. There are only a handful of longer streaks where the index has maintained that close proximity to the 50-day moving average. So what does that mean, and which way is this ultimately going to break? Well, ranges are common structures. We see them on charts all the time. Charts spend a lot of time in ranges. They trend for a while, but then we get the ranges. Ranges will form, and they're the lull that follows periods of activity, and they're really holding patterns ahead of another period of price momentum. The fact that this ranging period has been longer lasting than most, I think that really does increase the significance of the eventual breakout. There's no way to know which way it's going to break. We never know that. We can have a view on which way it's going to break. We can say the odds favour, but we never know for sure which way these things are going to break. The breakout from compression patterns, and this is what we call a compression pattern, where the price action really tightens up. The breakouts from these, they often lead to strong momentum moves. And so this is something to watch closely for when we do get a breakout from this current ranging period. But this also isn't your typical range. It looks like a pretty typical range when we look at it on this chart, but it's actually anything but typical, because it gives the impression that the market is generally quiet. You'd look at this and go, well, there's not much happening in the US market at the moment, little movement in either direction. And while that may be true in an index sense, so if we just look at the S&P 500, that is actually the case. It's very different at a sector level. So starting with the NASDAQ, I'll show you what I mean. So starting with the NASDAQ, starting with tech, well, we've been discussing this weakness in the NASDAQ structure over the last few weeks. There's been some improvement this week with prices stabilising and then attempting to to push higher over the last, a couple of days ago. They tried to push higher, came back a bit on Thursday, but we've tried to see some strength out of there. But it still needs to clear the moving averages. And that's yet to happen, the 15 100-day moving averages. So it's really about clearing the moving averages, re-establishing above the moving averages. That's what we need to see. That's what has not happened yet. I think last week's low, I think this low from a little over a week ago, I think that remains a key level. So far, prices are getting a foothold above there, which is encouraging. The risk would be that prices lose that foothold, come back down, retest the low from a bit over a week ago, and break down, and then that brings the November low into focus. And if that breakdown were to happen, then we start getting a sequence of lower lows. That starts to develop. That starts to really shift the structure to a more negative footing. We're not there yet. That's the risk. That's what to look out for. But as I say, if prices can get back above these moving averages, then it disengages that vulnerability in the near term. The other point of concern for the US, as we've discussed in previous weeks, it's the Magnificent Seven, the big seven cap stocks: Nvidia, Microsoft, Alphabet, and the like. This is an ETF that tracks those stocks. MAGS is the stock code. So prices have rallied off a 5-month low during the week, but we still have consolidation below declining moving averages. The 15 100-day moving averages continue to roll over. They're getting close to crossing to the downside, and we're getting this consolidation below the averages. There's also a series of lower lows, which is also concerning. The question now is, will this low from a little over a week ago, will that hold, or will this latest rally be sold, sending prices down to a new lower low? So far, this is a shallow rebound. Shallow rebounds, we often talk about shallow rebounds, a shallow rebound when prices are rallying. Shallow rebound's a good thing, often leads to higher levels. Opposite applies in a down market. A shallow rebound is often where the rally's being distributed into, being sold. That can be a concern. So, is this shallow rebound going to be sold, or is it actually being able to be able to push higher? It would only take one or two strong days, and this could quickly change, could quickly flip from being below the moving averages to above. So I think this is a critical point. It's a critical point for where the Magnificent Seven are now, and it's critical for the Mag 7, it's critical for the NASDAQ, it's critical for the stock market generally. And this is where the US stock market really does become difficult, because the weakness we're seeing in tech is being balanced out by strength elsewhere, and that's why the S&P 500 is in such a tight range, despite such a large segment of the market having this concerning structure. So you can see what I mean by that when we go to the equal weight, the S&P 500 equal weight. This is on the verge of another all-time high. So it really does conflict with what we're seeing in the Mag 7. And look at the recent price action. It's a shallow pullback. We've had a strong rally off the moving averages, and we've had a shallow pullback. And it's also a tight little range prices have been in for the last 2 or 3 weeks. That's bullish. That's a bullish structure. It looks like it's on the verge of pushing higher to a new all-time high. And then another thing to show you, which is positive coming over, look at this indicator. This is the percentage of S&P 500 stocks above their 100-day moving average. Look at where it is now, and it's at 67%. So participation continues to broaden. It's broadening participation. 67% of S&P 500 stocks above their 100-day moving averages, and it looks like this percentage is about to break higher after several weeks of just trading sideways around that mid-60 region. It looks like it's on the cusp of pushing higher. So again, that's bullish. That's bullish structure we're seeing throughout the market. I'll show you one more thing I find interesting on the US markets, and this turned up on my X feed. Actually turned up this morning. I was looking at this. So this is from the AAI members survey. So the American Association of Individual Investors. It asks them, are they bullish, bearish, or neutral? Look at where the X feeder has marked the survey. There are actually more people, more recipients of the survey at least, more are bearish at the moment than they are bullish. So, and that's been the case for the last 2 weeks. Last week it was 37% bearish, 34 bullish. This week it's 33 bullish, nearly 40% bearish. That's really interesting, isn't it? When you get a survey, the market is, just think, the S&P 500 is within 1.5% of an all-time high, yet there are more bears than bulls. To me, it seems like wall of worry mentality. It's not what we associate with tops. Tops are normally about exuberance. This feels like wall of worry to me. People worrying about tops when maybe tops aren't really being made. The small caps are also interesting. I'll get to them in a moment. Just quickly back to the S&P 500. The lack of momentum that we're seeing here, it hides a lot of movement below the surface. I've seen just over the last week, I've seen plenty of bearish and bullish arguments, and both sides have valid points. The bears have some valid indicators they're talking about. Bulls have other things they talk about. When I weigh it all up, I look at all the information, I look at the structures on the chart, I look at the trends within the various sectors. There's a lot of it's conflicting, but my leaning is that the S&P 500 my leaning is that it breaks to the upside. As it stands, the bull market remains intact. I believe the correct approach is to give the incumbent trend the benefit of the doubt, and the benefit of the doubt is for higher prices. For me, that means continuing to hold stocks in uptrends, giving them room to move. So if we do get, doesn't say there can't be some near-term volatility or near-term pullback, but just giving winning stocks room to move in this environment. And but at the same time, recognizing there are cross currents that aren't evident on the surface when we look at the S&P 500. I also think it's important to avoid overconfidence in any scenario, whether you're a bull, whether you're a bear. Not a time for overconfidence. It never is a time for overconfidence, but particularly around now when there's so much non-confirmation going on. And lastly, have a plan to respond to the price action. That means having an exit strategy for stocks that are breaking down, and also having a strategy, having a buying strategy when we see stocks that break out. Repeatable success is all about having a good plan and then implementing it over time. Okay, so let's jump over to the small caps now. We're going to look at the US small caps, the Aussie small caps. We've got the commodities to go through, lots of stuff going on there to have a look at, and then your stock codes. We'll go through them next after we go through the stocks and commodities. But of course, that wraps up the free section. If you're not a strategy session member, there's a link below. It doesn't cost you very much. I think you're going to get a whole lot of value from what we go through. Think about clicking that, making that small contribution to make it all happen, and join us in the members section of the strategy session. Okay, so let's go over. Let's start off with the Russell, the US small caps.